Welcome to Breaking News to Trading Moves. Today we're focusing on a specific economic release, one that really caused some ripples globally, actually. It's the Australian labor market report for September 2025. Yeah, the headline number that caught everyone's eye was 4.5%. That's the new Aussie unemployment rate.
Right. Jumped up to its highest since, what, November 2021?
Exactly. And digging in, the details weren't great either. Employment only climbed by about 14.9 thousand jobs.
Which was quite a bit lower than what analysts were forecasting, a definite miss.
And for the markets, well, that miss was like instant fuel for volatility.
Oh, absolutely.
This week, jobs data immediately kicked off a big reaction. You saw bets surge for a rate cut from the Reserve Bank of Australia, the RBA.
The markets started pricing that in very quickly.
And at the same time, the Australian dollar, the AUD, took a hit. It softened quite a bit.
Yeah, classic reaction. Weaker data, rate cut expectations rise, currency falls.
So that's what we're going to walk through today. The immediate fallout from that market reaction, basically. Who were the winners and who were the losers right after that news dropped?
And it's important to remember, when you get a data miss like this, markets don't really hang around waiting for the central bank's official word.
They move first.
They move first. They react to what they think the RBA needs to do. So we saw traders pricing in much higher odds, very sharply higher odds, of an RBA rate cut at the next meeting.
So it's that expectation of cheaper money driving things.
That becomes the main engine, yeah. For certain types of assets anyway.
But maybe talk a bit about why this number, 4.5%, caused such a strong reaction. We see soft data points sometimes.
That's a fair point. I think it's because the consensus view was already a bit fragile. You know, the RBA had been trying to walk this tightrope between keeping inflation down and managing slowing growth. They still sounded quite hawkish.
Okay.
This jobs report, it wasn't just weak. It kind of undermined the RBA's story that the labor market was strong enough to handle the current interest rates.
So it poked a hole in their narrative.
Pretty much. It basically signaled to the market, hey, maybe policy's too tight right now, and the RBA might be falling behind the curve. So the data kind of forced the market to adjust its rate outlook very, very quickly.
Right. And that adjustment created these two big forces you mentioned.
Exactly. Two powerful things happening at once. First, the expectation of lower local interest rates, or discount rates. Second, that immediate drop in the Australian dollar.
Okay.
And if you understand which assets benefit from one or both of those, well, that explains a lot of the trading action we saw.
Got it. So if lower rate expectations are the engine, who jumped in the slipstream first? Let's start with maybe the most obvious ones, gold miners. Seems like a classic play.
It is pretty classic, yeah. But the strength of the move often depends on that combination of factors. Gold itself tends to do well when real interest rates fall.
Meaning rates adjusted for inflation.
Exactly. So if the market suddenly expects the RBA to cut rates, that suggests lower returns on safe assets like bonds. And that makes gold, which doesn't pay any yield, look relatively more appealing.
Okay, makes sense. And the weaker Aussie dollar is just icing on the cake for Australian gold producers.
Absolutely. It's a huge boost. Gold is priced globally in US dollars, right?
Right.
So if you're an Australian company digging gold out of the ground and the AUD gets weaker against the US dollar, well, when you convert those US dollar gold sales back into Aussie dollars, you just get more of them.
It's like an instant bump in revenue from the currency move alone.
Precisely. And we saw that play out with some big names. Take Newmont, told me NEM.
NEM, right. They have a much bigger Australian presence now after buying Newcrest.
They do. So those hopes of rate cuts, plus the weaker AUD helping the revenue translation, that gave the stock a lift.
Okay.
And similarly, Agnico Eagle, ticker AEM. That stock's usually quite sensitive to gold prices overall, and it tends to benefit when those real rate expectations decline. So it's all buying interest, too.
So gold miners, a pretty direct, logical beneficiary of both lower rate hopes and a weaker currency.
Definitely.
All right, the next group of winners you flagged is maybe a bit less obvious at first glance. Data center REITs, real estate investment trusts. Specifically ones with operations in Australia. Why are global tech-related property companies sensitive to an interest rate shift down under?
Yeah, it might seem a bit indirect, but it boils down to valuation. It's all about the duration of their income streams.
Duration, meaning how far out their expected earnings go?
Kind of. Think about it like this. A data center REIT builds a facility, signs long leases, and expects to collect rent for potentially decades into the future. Very long-term cash flows.
Okay.
Now, when analysts value these companies, they take all those expected future earnings and discount them back to what they're worth today. The interest rate they use for that discounting is crucial.
Ah, so if the expected interest rate goes down,
Then the present value of those far-off future earnings goes up, quite significantly, actually, for assets with very long durations like
yeah.
REITs.
So lower rate expectations in Australia directly boost the calculated value of these REITs, even the global ones with local sites.
That's the key. It's very much an interest rate sensitivity thing, almost pure valuation math. So a company like Equinix, ticker EQIX,
EQIX, they have sites in Sydney and Melbourne, I think.
they do. So even though they're global, the easing of local rate expectations is a direct positive for how the market values their Australian assets, and thus the company overall.
And the same logic applies to Digital Realty, ticker DLR.
Yep, DLR. Huge global footprint, including a lot in the Asia-Pacific. They benefit from that same dynamic, lower expected borrowing costs or discount rates boost their valuation profile.
Okay, that makes sense. Discount rates are key there. The third group of winners, brokerages and derivatives platforms. This seems less about the rate cut itself and more about the chaos it caused.
Well, chaos might be strong, but yes, it's about the activity it generated. That sudden, sharp drop in the AUD, plus all the other assets repricing based on the new rate outlook.
Gets people trading.
Exactly. It creates a surge in trading volumes, particularly in foreign exchange markets, like the AUD-OD pair, and in related futures contracts.
Why the spike?
Well, institutional players might need to quickly adjust currency hedges. Retail traders see the volatility and jump in, trying to profit from the move. Any sharp directional move tends to boost volumes.
And more volume means more business for the platforms facilitating those trades.
Precisely. It's a direct link to their revenue. Think about Interactive Brokers, ticker IBKR.
IBKR, known for lots of FX and futures trading.
Right. They generally thrive when global currency and futures markets get active. More volatility often means higher trading volume for them.
Okay. And it's not just the pure FX or futures guys.
No, it can be broader. Even a large brokerage like Charles Schwab, ticker SCHW,
SCHW.
is a benefit. Just general market volatility often leads to more trading activity overall. Portfolio managers rebalancing, tactical traders making adjustments based on that new RBA outlook, it all contributes to higher trading-related revenues.
Okay, so wrapping up the winners, we had gold miners getting a boost from rate hopes and the weak AUD, data center REITs benefiting from lower discount rate expectations, and brokers profiting from the increased trading activity.
That covers the main groups, yeah.
All right, now let's flip the coin. Let's talk about the losers. The sectors that didn't like this news. These seem to fall into categories hit by worries about Australian growth itself or hurt by that weaker currency.
That's right. And the first group that showed weakness were the big diversified miners, especially the iron ore producers, which is interesting psychologically.
How so? They're huge global companies, aren't they? Selling iron ore mainly to China. Why does a jump in Australian unemployment hit them?
It's partly about sentiment and maybe proxy risk. These companies, even the global giants, often have massive operations in Australia and are major components of the Australian stock market index, the ASX.
Okay.
So when a key local indicator like the jobs report flashes warning signs about Australian domestic demand, maybe slowing construction activity, it just creates caution around these names.
Even if their main customer isn't directly affected.
Yeah, and sometimes their U.S. listed shares, the ADRs, almost trade as a sort of proxy for the health of the Australian economy in the eyes of global investors.
Gotcha. So we saw that with, say, BHP Group, ticker BHP.
BHP, exactly. Very heavy Australian exposure. It felt that pressure from the domestic growth concerns. Same for Rio Tinto, ticker RIO.
RIO. Another big miner, U.S.-listed ADR, sensitive to Australia and iron ore prices. They lagged, too.
They did. It suggests the market was immediately factoring in some increased risk related to the Australian economy.
Okay, beyond the miners with direct operational links, the next category seems more about, well, accounting.
Yeah.
U.S. multinationals that make a decent chunk of money in Australia.
Yeah, this is purely about the currency translation. It's that classic foreign exchange, or FX, drag.
Explain that drag again.
Sure. If you're a U.S. company, you report your earnings in U.S. dollars. But you might sell a lot of goods or services in Australia, earning Australian dollars.
Right.
If the Australian dollar weakens against the U.S. dollar, like it did after this jobs report, then when you translate those AUD earnings back into USD for your financial reports, you simply end up with fewer U.S. dollars.
Even if you sold the exact same amount of stuff in Australia.
Exactly. Your Australian business could be doing fine operationally, but the reported U.S. dollar value of those sales just shrinks because of the exchange rate movement.
Which means their next earnings report might look weaker purely because of the currency.
That's the potential headwind. We saw stocks like News Corp, ticker NWSA, react. They have significant Australian media operations.
NWSA, right.
So a weaker AUD directly impacts their reported top-line numbers in USD terms, all else being equal. And it's not just media. Think about consumer goods companies too, like Estee Lauder, ticker EL.
EL Cosmetics and Skincare.
Right. They have broad exposure across Asia-Pacific, including Australia. For them, a stronger U.S. dollar relative to the AUD represents a direct currency drag on reported sales from that region.
Okay, so that's the translation hit. Finally, you mentioned a group facing kind of a double whammy. U.S. companies exporting big-ticket capital goods to Australia.
Yeah, this is where both the growth concerns and the currency move can bite.
How so?
Well, first, the weak jobs data might make Australian businesses more cautious about making large investments in new equipment. They might delay capital expenditures if they're worried about the domestic economy.
Okay, that's the growth concern part.
Then, add the currency effect. The weaker Australian dollar makes imported goods, especially expensive ones priced in U.S. dollars, immediately more costly for Australian buyers paying in AUD.
Ah, so that new piece of machinery just got more expensive overnight for the Aussie customer?
Exactly. If you're an Australian mining company or a farmer thinking about buying a big new tractor or earth mover from the U.S., that sudden price jump, combined with maybe feeling a bit less confident about the economy, could easily make you postpone that purchase.
Which hits the order books for the U.S. exporters?
Correct. You look at a company like Caterpillar, ticker CAT.
CAT construction and mining equipment.
Their big machines just became significantly more expensive in AUD terms. That's a direct headwind. Same sort of dynamic for Deere, ticker DE.
DE, agriculture and construction equipment.
Yeah, demand for their imported farm or industrial gear in Australia faces that same challenge, potentially cautious buyers plus a higher effective price tag due to the weaker AUD.
Yeah.
So we bring it all together, that Australian unemployment number really created a very clear split in the immediate market reaction.
Seems like it.
On one side, you had assets that benefited from the expectation of lower interest rates. Think gold miners, those data center REITs. And maybe from the trading churn, like the brokers.
Right. Cheaper money hopes.
And on the other side, you had companies that were more exposed to concerns about Australian domestic growth itself, like the diversified miners, or those facing that negative currency translation effect, like some U.S. multinationals and exporters selling into Australia.
So that single data point, 4.5%, really sorted the market out pretty quickly, defining where capital wanted to flow, at least initially.
It really clarified the immediate winners and losers based on those two main forces, rate expectations and the currency move.
Yeah, and it really makes you think, doesn't it? How quickly similar data from other places, maybe a surprise jobs number out of the Eurozone, or Canada perhaps, could ripple through their rate-sensitive stocks even before any central bank actually says anything.
Absolutely. It underscores how markets anticipate policy.
Oh.
You almost have to watch every major economic print globally now with that kind of sensitivity in mind.
Definitely something to keep an eye on. And just a final reminder for everyone listening, this discussion is not financial advice. We're not giving buy or sell recommendations here.
No, this is purely based on our analysis and opinions surrounding the market reaction to this specific news event.
Exactly, purely the opinion of the author.